Hello everyone. We'd like to go ahead and get started today. Thank you so much for joining us. I'd like to welcome everyone to our Good Governance Part 1, Attracting Talent and Building High Performance Boards. Based on the overwhelming response we received to the governance session at this year's Roundtable, CapitalPlus Exchange and the Small Business Banking Network, as well as the SME Finance Forum, are proud to present the first in a series of webinars on good governance that begins to answer many of the questions raised by bank CEOs at the event. We would also like to welcome so many of our partners and stakeholders on the call. We are delighted to have the early supporters of CapitalPlus Exchange and the Small Business Banking Network with us today. Our webinar today is presented by Peter Hinton, an SBBN expert with 21 years experience in countries across Asia, Eastern Europe, Middle East, and Africa. Peter is an associate fellow at the Syed Business School at Oxford University. He is an internationally recognized entrepreneurial leader who has invested in and transformed emerging market financial institutions and banks to improve performance. We'll be doing a two-part series on problem loan prevention and problem loan management in August and September, and then we'll have another session on governance in October. These webinars are all free of cost for current SBBN institutional members, and you can access our forthcoming webinar program and register at the email listed below. We do encourage you to send out the webinar calendar to those who would benefit at your institution. And I would now like to turn it over to our very experienced facilitator, Peter Hinton.
Thank you very much, Jessica. Good morning, good afternoon, everybody. It's a pleasure and a privilege to be involved in this webinar and to look at, in particular, governance and the whole area of attracting talent and building high-performance boards. This webinar came out of the forum that took place in Istanbul in May this year, and where we asked CEOs and chairmen what were the key questions that they had in respect to good governance. And we ended up having really a significant pull from those CEOs and chairmen of boards of key areas that they face in terms of dealing with good governance and trying to improve it. And one of the areas that we wanted to focus on today was the four areas that you see beneath you: attracting talent to your board, the role of board members, and the performance measures of boards, and how to strengthen weak boards. Now, these questions have been grouped into the 55 questions that were asked by the participants in Istanbul have been grouped into those four areas, because we just thought that was the most sensible way of addressing the key issues. But by doing this, we're looking to try and address 29 of the 55 questions asked. That's 53%. So just to give you an idea of the kind of specific questions that were being asked, I'll just read two or three of them to you now. How do I get more independent board members on my board? The second question, strong governance requires strong, capable leadership. How do you attract and seek talent for MSME boards versus commercial banks who already have this? And a third question, NGOs and non-profit MFIs, how do we strengthen weak governance coming from social justice but not strong management skills? So hopefully that gives you a flavor of the kind of nitty-gritty questions that people were asking in terms of how to improve good governance. So what we're going to do is look at these areas of attracting talent to boards, independent board members versus shareholder board members, board performance, and the evolution of boards, strengthening those boards. So moving on to attracting talent. And as Jessica said, if you have questions as we go along relating to particular slides, do post those through to her, and she will work on them and communicate them at the appropriate time. And then we will go through the rest of the slides as we cover the different areas. So I will speak for approximately 30 to 40 minutes, and then we'll have question and answers at the end of that time so that we can actually make this as interactive as possible. So moving on to attracting talent. It may be an obvious thing to say, but defining the skills already present at the current board level is the starting point. One has to begin with an assessment of what skills and experience the current board has. And if one hasn't actually addressed that, then it's very difficult to know what talent one needs to bring on board. So a key area, and this is really down to the chairman to instigate, is to do an audit of the current skills present in your boards of directors today. Not yesterday, not tomorrow, but what is the current skill, presence and ability and experience in your board today. Once that's done, then the next task is to define the current composition in terms of shareholder versus independent. So when I say independent, we're talking independent non-executive directors. They're not representative shareholders, they're not management members, they are completely independent, selected for their own experience and ability and the contribution that they can make to the board. So we're now going to move to a poll question which asks you, if a board has 8 members with an independent chair, what do you feel the ideal number of independent NEDs should be?
Great, and this is where we would ask for our participants. You can go ahead and begin to answer this. We'll take about 1 minute because we want to hear from you. And I'm starting to see some responses coming in, so we'll take about 45 more seconds here for this. And we're getting a nice mix, Peter, so I think there's going to be some good discussion on this. There's not a clear winner so far.
Totally good.
So we'll take about 30 more seconds here to answer this. Now we'll see the responses. So not one clear winner, Peter, so I'll let you speak about that. The winner is 39% have voted that 3 is the ideal number. 30% have mentioned 4, 17% 2, and 13% 5. So no responses for 6, but a good mix with a majority voting for 3 and 4.
Okay, so that would mean that with an independent chair, either 50% of the board would be independent, and with a 33% voting for 4, that would mean that the non-executives would be effectively in a majority. And what's I think is interesting here is the greater awareness today of the need for these independent individuals to be on boards. And yet some of the questions that we've had asked is, well, what happens if you've got a founder, family owner running the board and fills it with people that he knows and has friends of who may be officially independent but actually are not as independent as one would perhaps hope. So I think the poll shows that there is a majority of you listening that see the importance of having either an equal number of independent NEDs or a majority of independent NEDs versus the non-independent sort of directors. And what we'll come on to is, okay, how do we make that board effective and how do we measure the performance of that board and make it stronger? But before we do that, what I think we need to do is, if you as an organization, financial institution, believe that with the majority of the people polled, that it should be an equal or majority number of independent non-executive directors, when you look at your own organizations today, the question is that the case? is your own board showing that the majority of NEDs, the majority of board members are independent? And if not, then you may want to take action to address that. So going back to the whole thing of attracting talent, once one has defined the skills already present, one's looked at the current composition, then we need to define the gaps, both in terms of independent versus non-independent, in terms of skills which might be missing. They could be legal, they could be marketing, they could be related to age. You know, what do we want this board to look like? What should the gender mix be? What should the local content be versus international content? What should the cultural content be, particularly if it's a regional bank that's expanding? Does it want the board members all to be from the, as it were, the holding company background of the organization, or do we want to actually bring in board members from some of the other countries where we are operating? So the clear area that we need to do is to define the gaps to make sure that we can fill them and get a board which looks like the board that we want it to be. That board and the definition of the gaps needs to be done, obviously, in the light of the strategic plan. So if a financial institution doesn't have a 3-year strategic plan, then it's going to be very difficult to identify the gaps that will be needed to be filled over the next 12 to 36 months. So once the strategic plan is referred to identify the board member gaps, then one can begin to actually source the talent that's needed. Now, what are the ways one can actually source this talent? Typically, people often criticize boards as being clubs, and in many cases they're very male, very pale. In other cases they're friends of the chairman or the MD. There isn't really a transparent process and policy put in place to identify the kind of board members that we're looking for and the recruitment process. So we would encourage all organizations that are looking to improve good governance to actually have a clearly stated policy and procedure for what their process is for attracting talent to their board, and to be open about that with the internal organization and the external world, so that people know that the organization is serious about that. In the same way as you would seek to recruit senior management through headhunters, headhunters provide a reasonable source for finding good non-executive independent directors for financial institutions. So it may be appropriate to contact headhunters in the countries where you operate and say, this is what we're looking for, or if you're looking for an international person to complement what's already there, you may want to contact international headhunters and talk to them about what you're needing, who you're needing is, the job description, the tenure, and so forth. Another source is to actually contact existing board members and ask them who they would recommend. Having established the objective criteria and what talents and skills and experience you're looking for, then existing board members have a very valuable resource in terms of providing names of potential candidates. So that's another area of sourcing talent. A third area is looking at the alumni, people who have worked for the organization and left for whatever reason, who may have gone on to greater positions of responsibility abroad or locally, but still have a contact and still have hopefully an affection for the organization which they were with once upon a time, and they may now be suitable candidates to be brought on board to provide the talent that's needed for the organization. One may also want to consider service providers, so people providing IT, marketing, legal, accounting, other commercial banks providing, say, corresponding banking relationships. these service providers to the financial institution may have suitable people in their own organizations that could be relevant to the talent that we're looking to get, or they may know of other people who are not in their organizations but they would think would be ideal candidates. Obviously one needs to be aware of a conflict of interest, but these are service providers of your financial institutions that want you to succeed, because as you grow and succeed, they should be providing you the services that are important for you achieving your goals. So asking them may be a good and valuable source of attracting talent. A rather strange one is competitors. In any market, one has competitors that one speaks to and respects, and particularly if some of the financial institutions, as we know in the network, are small compared to the market dominant players, it may be appropriate to go and speak to the CEOs or the chairman of the larger players saying, do you know of anybody who we could approach who might fill our talent need at the board level? Because typically a board only has a maximum number of board members, and once that's full, then there may be other people that large commercial bank, for example, may ideally want to bring on board but knows that they can't because they're already full, they may be prepared to introduce you to and say, well, this will actually be a good fit for that individual because we couldn't use them at the time. Foreign banks that you respect and work with may also be a source of talent, and that's where the SBBN network and the SME Finance Forum members can actually play a role. There may be organizations in the network that are further down the line in terms of their own development and progress who would be prepared to recommend individuals that would help grow your board quality and talent. So I would encourage you to look at the other members and see whether they might provide a suitable reference. And then lastly, I put in here central banks because they have a obviously vested interest in seeing financial institutions succeed and grow, and they want to see, and often they assess their understanding of the quality of the board when they do their annual reviews. So they also may be prepared to give you names to find the talent that you need. Two last points. One, in terms of attracting talent, one does need to consider that this is a highly responsible position that you're asking someone to fill, and therefore the remuneration that one is prepared to pay them is important and needs to be addressed up front. One typically would want to benchmark what you can pay versus what the market is paying. One also needs to look at a kind of budget for time that one is expecting to draw on for that non-executive director. And typically, in my experience, one's looking to budget for 20 to 30 days per annum, particularly if one wants that individual to sit on subcommittees of the board like credit or remuneration committee or audit committee. That needs to be factored in. And one also needs to consider whether there are financial and non-financial sources of remuneration that can be provided. If one is constrained in terms of how much one can pay in terms of cash, there may be non-financial areas which one can compensate the individual with. And one may also want to consider doing some form of employee stroke director share scheme where one creates a pot of money based on the performance of the shares. And so I'm not saying you have to be a quoted company to have a share price, but in terms of some formula for saying this is how much the business is worth today, and if over a period of time that value using the same formula increases and one wants to recognize the directors and reward them in some way connected to that increase in valuation, one could actually have effectively a shadow scheme whereby a pot of money is used there to reward the directors on a deferred basis because the money is not there today, but they can be rewarded in due course. And lastly, the attracting talent, looking at the duration of what one is looking the individual to commit. Is it 3 years? Is it 1 year with a probation period? Does one ought to really have a policy in terms of the maximum period for any board member is 9 years. As you'll be aware, typically board members rotate every 3 years. So it may be that you have a maximum of 3 rotations to, and then a board member must leave the board of directors. But this needs to be clarified so that, and also the other thing to bear in mind is one doesn't want all the board members to be retiring and rotating at the same time. So if one can sequence the rotation cycle so that with a board of 8, it should on average be 2 or 3 per annum that are coming up for reselection. So that tries to thereby ensure some continuity, and means that the talent that you're replacing and then bringing on different talent is done in an ordered fashion. So hopefully in that area of attracting talent, one has provided some thoughts and ideas in terms of how one goes about addressing this very important area. If I can just maybe give 1 or 2 case studies of where this has been done in practice, the lessons learnt, so that we go from, as it were, the conceptual theory side to the reality. I was involved with a bank in Ghana, which is now called Societe Generale Ghana. It used to be called SSB Bank, the 4th largest bank in the country. And it was quoted, so obviously it was a sensitive issue in terms of who was on the board and financial information and so forth. At the time I was working for CDC, and we took a 20% stake in this bank. And one of the issues that we found is that one of the shareholders had a management agreement which was very one-sided. So that shareholder received a fee as a percentage of profit regardless of any other shareholders. So it was very one-sided, that they benefited and the rest of the shareholders didn't, and we didn't think this was very good governance, we didn't think it was very fair, and we wanted to change that. What we did on the governance side was we actually put in an experienced banker, 30 years experience working for a blue chip, Pan-African, Pan-Asian financial institution who'd retired. So although he'd retired from the bank, he still had the energy and desire to use his skills and experience to add value to smaller banks in a Ghana situation. And he would go into board meetings and be prepared to ask difficult questions of management and work with the board directors to build that financial institution, and in particular to address that issue that we were concerned with. And within the first year of him being there, through discussions with other board members, that management agreement, which is very one-sided, was actually torn up and removed from the equation. But in terms of the lessons learned for this individual, why was he attracted to come and work for a smaller bank than he had historically worked for? And why was he prepared to go into battle on some of these issues rather than just have a nice, relaxed life? Well, for him, the challenge was clear. We knew what we wanted to do. We wanted to grow this bank into being a very successful SME bank. We wanted to improve its portfolio quality. We wanted to change that poor governance. And his experience was highly relevant to what we wanted to do. And he knew the terrain. He'd worked in that country. He'd worked for that type of bank in that operating environment with the regulators. So the regulators knew him. He had a reputation with them. He had a reputation in the financial sector because other people who'd worked for his bank knew him and knew his reputation, and in many cases had worked for him. So when he went to visit the country to board meetings, he could connect with the banking fraternity and get market information, but also that proved valuable in terms of attracting some good people to work for the bank that we'd invested in and leave where they were, And so he became a magnet for attracting talent as well as being an effective board member. Critical to this was he was able to build relationships with the other board members, and they developed a sense of trust in his observations, his questions, his comments, and that became a very valuable relationship that we built on. And what happened was, after 4 years of investing, SocGen came along and were prepared to pay a premium to acquire a controlling stake in that bank because it was seen to have good governance, good performance, good controls, and so forth. A second example is an entity in the UK, which is a retail outlet called NISA. The reason I mention this is a non-executive director called Gillian Wilmot went on to the board of this retailer and won an award earlier this year as an effective non-executive director. What happened here was the entity was in crisis. It had largely been run along Asian lines, where it was an Asian family major shareholder, and it was largely a male-dominated culture. That had resulted in the chair resigning, in 2 non-executive directors leaving, and Gillian Wilmot was brought on board to try and address the gender issue, to address the non-Asian. She was non-Asian, and she also had retail experience. So it addressed some of the gaps that the organization had recognized, and they needed to attract talent of that. What happened was a good relationship was built up with the CEO. A little bit like the story before, Gillian managed to attract a new chief operating officer that strengthened the management team. They put in place a long-term incentive scheme, so there was an objective measure of management performance, and that was rewarded over a long period of time, not short-term. And she was catalytic in attracting new business, which was worth $1.5 billion over 5 years to the retailer. Again, why was she attracted to such a situation? I think, in my experience and the experience of NISA, good people like taking on a challenge. If it's a board position which is just going to say, please maintain the status quo, turn up for 4 board meetings a year and go home, that is not really very interesting to highly talented, highly motivated individuals that like to help organizations and work with organizations at board level to expand and grow. So when you're looking for highly talented people, it's very important to try and attract those that want to make a contribution, not just have a position. Moving on, because we haven't got time to look at DFCU, picking up again on some of the questions that people were asking, what are the role of board members? We've looked at the independent versus shareholder split and the importance specifically of having independent people who can ask critical questions, debate issues, have diverse views, and counter any dominance by a CEO or other board member. It's not healthy if you've got a board full of yes people. You really need to have independent people who can ask those difficult questions and have that independent thinking and that critical view of proposals brought to them. So a clear role of the board members is to provide that critical, challenging question asking before decisions are made and implemented. Another role of the board members is in terms of whether related party transactions that are proposed, again, waving the flag of what is best practice, what is good governance in this situation. And a situation I was involved with in East Africa related to the actual chairman asking for a large loan from the bank to finance one of his businesses. And in this situation, we didn't have a clear policy in place saying we don't want to do related party lending and we will not do related party lending. Obviously, we had the regulatory requirements in place, which said that if it's over a certain amount, typically 20% of net worth, it would have to go for board approval. And what happened in this situation, because it was over 20% of the net worth of the bank, it came to the board, and it was very uncomfortable for the CEO, very uncomfortable for the board to turn around to the chairman and say, we are not prepared to do this. What would have been better, and the lesson that we learned from this situation, because the reality was that a fire took place at the factory, the loan having been made, and fortunately the insurance policy covered the bank in terms of the loan was repaid, but from the proceeds of the insurance claim, not the cash flow of the business. So we were fortunate in the outcome, but what we learned was we should have had a policy in place from the beginning saying we will not lend to anybody on the board either above a certain amount and stick with it and have that as a minimal, a sensible level, maybe 5% of net worth if at all, or preferably have a policy whereby we said we will not do any related party lending whatsoever, in which case we would then look to have relationships with other banks in the market who we could refer that loan to, and they would look at it independently and make a decision. And when they had similar situations, they could then refer loan propositions to us. So actually help each other remain honest and avoid these kind of situations where related party lending questions the governance of the whole financial institution, and in some cases can jeopardize it. So I'd encourage you to actually have independent board members that challenge related party lending, and that you adopt policies to prevent a situation arising which you will regret being in. Moving on to the role of board members and whether they should be asking strategic questions or operational questions, the answer is they should be asking both, because although the board's primary responsibility is to do with the direction of the organization and its strategy and achieving its strategy, board members should not be scared to ask nitty-gritty operational questions of management and to be naive in terms of making sure that the answers that they receive they are satisfied with, so that they fulfill their responsibility clearly. The financial crisis in 2007, 2008 is a clear example of this, where board members, it would appear, didn't understand derivatives and the risks that were being taken, but rather than ask detailed questions to actually make sure they did understand it properly before approving it, they bowed to what they perceived to be the superior knowledge of management. And we know where that ended up. So you do need to have board members that will ask strategic questions in the first instance, but be prepared to ask operational questions if they are uncomfortable with a particular area. Obviously they need to avoid micromanaging, because that's the job of management, but certain operational issues are important to drill down into if something is not looking right or is causing concern. Another question that came out of those Istanbul questions was addressing political interference. What do you do when a bank comes under pressure from the government to make a loan or to do a certain activity? And what do you do in particular if the government is a shareholder when asked to do such a thing? Well, in the latter case, it would be politic to say, if we're making this decision, the government has to be absent from the table, so such a decision is made by the board members without the government shareholder or the government board member, if that's the case, who is obviously conflicted. But what we have found and what I found in practice in terms of addressing political interference is if you have a strong independent board, and if that board is in good standing with the regulator, and they have clear policies and principles saying we do this, we don't do that, when political pressure is brought to bear, the CEO, the chairman, have to stand up to that pressure and say, this is our policy, this is what we have agreed to abide by, this is what we can do, this is what we can't do, and they almost revert back to the board and its role as being the reason why they have to not go the political interference route but stand up to that. This is not an easy thing. This is not an easy thing to do, but it's the only way to protect a financial institution is if the board stand together against political interference and, if necessary, are prepared to resign if the political interference and the pressure is so great that they don't feel that they can continue in that role anymore. That will be the in extremis position. And obviously that brings us up to the next point in terms of the importance of the chair and the role that he or she plays in terms of representing the financial institution as it relates to government and as it relates to the market. And leadership style and values is also an important aspect in terms of the role of the board member and the way they perform their role. And the webinar that we're looking to do in October will go into the role of the chair and leadership style and values and culture in far more detail, so I won't dwell on that now. So moving on to board performance, and one of the questions that was asked in Istanbul is, how do we assess the performance of the board? And what I'd like to do is have another poll and ask the question, have you as a financial institution done an assessment of your board's performance? And if yes, how often? So Jessica, do you want to manage that poll?
Great. You can answer yes or no in the quick poll, and if you're answering yes, please also type into the chat box and let us know how often you are actually doing this assessment. Are you doing annually? Are you doing it quarterly, twice a year? And I do see that about a third of you are responding yes. You have done a board assessment, so let us know how often you have done that assessment. Yearly, annually, so we're seeing this on an annual basis from the responses. 1/3 are saying yes, and that has been done on an annual basis by those institutions. And 2/3 are saying no, they have not done an assessment at this point in time of the board's performance.
Okay, thank you very much. And that isn't untypical. When one looks at companies across the world, it's the minority that are doing board performance assessments, which is understandable in terms of people not necessarily being willing to look at themselves in the mirror and say, how are we doing? But it's rather strange when one looks at the performance of financial institutions, and we typically do assessments of staff and evaluate their performance. We typically do assessments of management and evaluate their performance. Often we link these things to reward either salaries, increases, bonuses, and so forth. But it's the majority of boards in this poll and is that we don't do an assessment of the board's performance. And it would seem, in terms of going back to our overall question of good governance and how one improves the governance of financial institutions and builds high-performance boards, that I would argue very strongly that if you want to be a high-performance board, you really do need to assess your own board's performance. And again, how does one do this? Different financial institutions typically would either use self-assessment or external assessment. Those are the two most common means of assessing performance. And what would be interesting as maybe a follow-on to this is to ask those that are doing their assessment of board performance whether they're doing it, whether it's self-assessment or external assessment, and what their experience has been and what the benefits have been, what the mistakes have been, because if as part of the network, as you appreciate, is to share experience and best practice and learn from each other, there may be some very valuable things that we can learn from members of the network in terms of what works well and why it works well. But just to comment a little bit on the external
Peter,
assessment
I'm
side.
going to jump in really quickly there. We did actually have a question about that as well, and one of our institutions, has done the assessment of the board, but struggles to institutionalize that as well. So maybe you could speak, about how an institution can do this more on a regular basis and institutionalize it, and not just at a crisis period.
Yeah. Well, I think this effectively brings us on to the whole October webinar, where we're looking at culture and how do you institutionalize good practice in an organization and bring it into the DNA of the financial institution, so that it doesn't just talk about something, or just in this instance doesn't do a board performance, but then it isn't actually acted upon, or the results aren't implemented, and no change takes place, because that's very demotivating and demoralizing for individuals. So if I may, I'd suggest that we look at how you institutionalize that in more detail when we look at culture, and how the culture of the organization is one that, in this instance, does a board performance evaluation, but the values are visible and agreed upon, and that almost enables people to challenge the situation if the evaluation isn't acted upon in the way that one would hope. So we can actually look at some specific examples in October of where this has happened, because I think it's a really key issue. But you have to, it's part of the whole equation of the values of the organization, and whether it's prepared to be an honest organization with itself and be transparent and be accountable, and people and the culture of the organization is such that it welcomes critical, constructive commentary on what it's doing well and what it's not doing well, which in this instance would be not acting upon an evaluation of the board's performance. I hope that goes in some way to answer the question. We can also answer this offline after the webinar in more detail on a one-on-one basis, if that will be helpful. And also it begs the question, was that assessment that was done, was it a self-assessment or an external assessment? Because part of the advantage of using external assessment people to do such a work is it can bring a greater sense of objectivity, and it may need to go hand in hand with what we were talking about earlier in terms of the skills assessment. So where 2/3 of the people involved in this webinar don't do a board performance assessment, it may be likely that they haven't done a skills assessment either, and what might be a useful exercise is to do a skills assessment hand in hand with a board performance evaluation, so that the organization starts to learn what is the current performance, what are the current skills, what are the gaps, and together work out a strategy of a stronger board coming together over a period of time and managing that process. And a key area within this is the 360-degree analysis, looking at each board member and the chair and asking subordinates, in which case will be typically management, but also regulators, peers, and each other, to comment on what they like, what they observe about the performance of the individual board members themselves, and to be able to work with the answers to those questions in a constructive fashion, so that the individuals have greater awareness of where they're making a positive contribution, but also where they may be weak, and not with a view of punishing those people, but then building on that knowledge to say, okay, what do we need to do to strengthen the board's performance and the individual performance of those board members. I think that's a vital part of an assessment, whether it's self-assessment or external. Frequency, it would appear that the best practice, just like you have an annual audit, self-evaluation, etc., doing it on an annual basis would seem to be the most sensible period at which to do it. And in terms of the pitfalls, the real pitfalls exist in terms of the chair doesn't believe in it, so it doesn't believe it's necessary, or the shareholders don't believe it's necessary, or they're fearful of what it might show, so no action is taken. These are real pitfalls that one needs to guard against. So that's why I say it goes back to the whole culture of the organization. Is it doing something seriously because it believes in it and is willing to live by the results of that? And there are obviously various organizations like Board Performance Limited, Institute of Directors, UK, South Africa, and Tomorrow's Company, etc., who are involved in working with boards to assess the board performance and strengthen them so that they can actually go from where they are today to being stronger tomorrow. So very lastly, I just want to talk briefly about strengthening weak boards. And I mentioned at the beginning the evolution of this slide, the evolution of boards. Obviously, as per the questions in Istanbul, some MFIs are becoming banks. Some banks are getting bigger and growing significantly, some at 20%, some at 50% per annum in terms of their asset base, and they're attracting new capital, new lines of credit, and growing significantly. As these financial institutions change, as the legal environment changes, as the technology environment changes, as the regulatory environment changes, typically boards need to change. But if you looked at your own financial institution and asked yourself, what has changed in the last 3 to 5 years at board level, would there be significant change that you could identify? And if not, then one would need to question why that is. Is it because the board has sufficient skills and abilities to meet all the changes that have taken place in the last 3 to 5 years, or is it perhaps because you haven't really looked into the mirror and done an evaluation of your board's performance and the needs and the skills required, and looked at that in the light of the strategy of the financial institution and where you want to be and wanted to be? And sometimes we can become complacent and say, well, this is the board, and just stick with what it is. So as financial institutions evolve, the board really should evolve as well. And the board in 5 years' time from today shouldn't really be 100% the same as now if the organization is growing and if the environment is changing. So I think one needs to be honest with oneself in terms of where one is in the cycle of growth and change, and what one will need over the next 3 years to give the financial institution what it needs. And that's particularly true where you have owner-managed financial institutions and wanting to move to a broader shareholder base. That's typically the evolution that most financial institutions go in, and when that happens, broadening the shareholder base does provide an opportunity to change the board significantly and to bring on professionalism and independence onto that board so that it becomes stronger. We've talked about the size of an entity. It's also relevant to the complexity of entity. If you're an MFI and then you become a bank, there are all kinds of things that you're going to have to do that you never did before. You're going to have to do with treasury, trade finance. The internal controls will be different. The systems will be different. The dealing with regulators, dealing with depositors, and therefore to bring on people onto that board who will actually have the skills and experience to guide you in those key areas should be a change that one sees to strengthen the board in those areas where historically it's weak because it's never had to do it before. It's not a criticism, it's just a reality. Similarly, if country presence is changing and as a financial institution you're expanding into new markets and new geographies, it may need that weakness of the ability to deal in different cultures, different languages, different jurisdictions to be brought on board to mitigate the risk and also manage the risk of that expansion cross-border. When it comes to things like gender, it's important, I think, to strengthen weak boards, weak in terms of not having the right gender mix. In the Financial Times last week, you may have seen something about the 30% club. There is a move in the UK that all boards should have at least 30% of board members being women. It's not saying they should be women without the skills and experience needed to be a good board member. That is a requirement as well, but trying to get a better, more healthy gender balance. And this is particularly true when one looks at the customer base of the financial institution itself. If, as in some MFIs, 90% of customers are actually women, and you've got a board with maybe only one woman, is that really a sensible mix? So I think where there's a weakness in gender, the board has to say, okay, what policy do we want to have? Going back to the question we had earlier in terms of how many independent non-executives does one want on that board, the other question that I think should be asked is how many female members of the board do we feel and do we want? And then in the light of that, and the light of the talent and skill, the talent sourcing and skill gap meeting, go out and find women that can meet those skill gaps and address the gender imbalance which is typically there. I mentioned the NISA example. I think that's quite a good one where a woman coming into that situation, highly professional, highly skilled, highly experienced, was able to work with what was a rather dysfunctional situation and work together to make a significant contribution. So I would encourage you to look at your gender mix and not be tokenistic, but be genuine in seeing and understanding why it's beneficial to your organization, and if it is seen as to be beneficial, to do something about it and have a policy to say over the next period of time, we will address this. And within that strengthening weak box, the last point I'd like to make is, it's not on the slide, but it may be a sensible thing to build up a waiting list of potential new board directors. So rather than wait for a resignation or an individual coming up for renewal and not being renewed and say, oh no, now we've got a gap to fill, already be building up a pool of talent that one's addressed, and ask them whether, if the opportunity came up, would they be prepared to come onto the board, so that you have a waiting list of people who you have a call on when you get to that point, and you can manage the timeline expectation. I think what's interesting is a board, a strong performing board, is not running a 100-meter race, it's running a marathon or a relay race. And different board members need to hand over the baton to new board members coming on who can then maintain the performance of that board. And in some situations, to strengthen weak boards, you may want to create a specific advisory panel or working group for a particular time, a particular challenge, to help the full board meet a particular issue. And so you may say, well, let's attract some new people onto a specific work group to help us with one particular area. So in summary, we've looked at attracting talent. This needs to be a dedicated activity. I think it's good to have a clear policy in place, a clear, transparent procedure to appoint and on what basis, and who ultimately is responsible for doing that within the organization. And that typically falls to the chair and a nominations committee in terms of identifying the talent, but it may be that you give that responsibility to the whole board, and the chair drives that process. The split of independent versus shareholder representation for directors, again, a clear policy needs to be put in place, and responsibility for sticking to that policy is required to avoid the domination of a board by an individual, so that it actually works as a productive debating forum to address and approve strategic and operational decisions. That's key to actually get the split right. And again, per the poll earlier, if the majority of you are saying that we think having 4 or 5 independent non-executive directors is the right thing to do, then are you living by that? And if not, is it time to address it and have a plan of action to do that? We'll come on to succession planning when we talk about culture in October, because culture and retention of staff and retention of board members and performance of board members is an aspect of culture. Thirdly, looking at board performance, it's again critical to decide, do we want to evaluate our board? And I would encourage individuals to do that. Work on that basis of having an annual evaluation, setting out what the formal procedures are, whether it's internal or external. It needs to be rigorous, and it needs to be lived by, and not just tokenism. And lastly, strengthening boards. Where on the curve are you in terms of your organization's evolution? What do you need? And can you map the performance of the board with the performance of the company, with the performance of the competition, so that you actually measure the board, and also where there are weaknesses, address them so that the board becomes stronger. So with that, I'll hand back to Jessica.
Great. Thanks so much, Peter. That was excellent. I think there's a lot of topics that we can cover in the next session, and I would like to open it up to questions now. We've had a few questions that have come in, so if there's an area that you would like Peter to expand upon or provide more examples, please post your question in the discussion box at this point in time, or in the chat box. And one of the first questions that we had is on the number of independent NEDs, as well as a comment on their role. And so the question is whether or not the number of independent directors depends on the number of shareholder organizations. So, for example, if there is one owner, are you looking at 50% or less shareholders, or fewer than that? Or will there be more independent directors if there are more shareholder organizations? And a comment from the same institution is, that it seems the role that you are promoting for independent directors is a devil's advocate role. But this comment or this participant says that boards should also be enabling and to support the FI, follow the strategy, not just necessarily block things because they're independent. So if you could kind of speak both about the independence and the role, that would be great.
Okay, in terms of shareholders, I think regardless of the number of shareholders, I think if one can agree what the policy is for the financial institution in terms of how many independent non-executives it will have, then that policy should be what dictate the number, not the number of shareholders. So when new shareholders come in, that's the policy that they will be asked to agree to abide by, rather than say, okay, I come in as a shareholder and therefore I am entitled to one board member. I think it's trying to establish what is right for the institution in terms of its strategy and its business, and if the number of non-executive directors is 5, then new shareholders have to abide by that. But it doesn't mean that they can't nominate individuals that they think are appropriate to fulfill that role because they've got the experience and skills necessary, but it means that that's the policy that's been followed. In terms of the independent, to be a devil's advocate is one role, but I completely agree that being an enabler and to enable the strategy to be followed is a critical aspect of the board member. So I think it's a both-and situation. They need to be critical, they need to be asking the difficult questions, and then the situation is it's doing both. Does that answer the question?
Yes, I think so. And we'll be able to respond more to these on our LinkedIn discussion boards if necessary as well. And so I think that there are some other questions in regards to this in terms of best practices for the ratio of the non-executive directors to shareholder directors in the developed world, so the UK versus some of the more emerging markets, as well as the number that should be represented by minority shareholders as well. So we've got some other questions on that. So I don't know if you want to speak to that now, Peter, or else we can address those later in some of our discussion boards.
I think why don't we address them in the discussion board? I think
Great.
that would be a more constructive way of doing it.
Okay. And we'll take just a couple more questions here as well. So we have a couple institutions that are double bottom line institutions, so that are looking both at the financial performance and then the social impact. And so they're curious if there's any differences in terms of board structure, board operations, or any other governance aspects that that institution would need to look at in regards to social impact.
Okay, so are there other elements that need to be brought into the equation, as it were? And I think the answer to that is possibly, but just as I was saying in the straightforward example of any financial institution, what is the strategy of the organization? What is the 3-year plan? What are they trying to achieve? And whether that's got more social objectives or less social objectives, more financial objectives, less financial objectives, market share, regional expansion, whatever it might be, it's that strategy that should determine what the board should look like and what skills and experience are required on that board. So in effect, if you as a more socially orientated organization are saying it's key for us to achieve these social objectives, then that should be fed into what the skills needed at board level are to give the organization what it needs to achieve them. So it will make a difference, but insofar as it identifies different skills that you need to achieve the overall objectives of the organization itself. The process is the same. Where is the organization going? What's its strategic direction? What are its objectives? And what are the skills that we need to achieve them? And then that in turn leads to what board members do we need to bring on board if those skills are not there today. So I think the process is the same, but the answer will be different for each organization depending on its own strategy and direction.
Great, very
Jessica?
helpful. Yeah, very helpful. I think one of the most interesting topics from our roundtable discussion was about difficult or even ineffective board members. And so maybe you can speak a little bit about how a board can work with board members that are purposefully being difficult, trying to be excluded from the majority decision, and how decision making can be improved and made more dynamic within the board, and also if you have an ineffective board member, what a board can do in that instance as well.
Okay, and this is often a common problem where you've got board members who effectively are passengers and not players. And you sometimes go to board meetings and you can have an individual there who actually is silent for the whole board meeting. And you have to ask yourself, what contribution has that individual made to the performance of the board, its effectiveness, the quality of decision making, and so forth. So it's an unfortunate reality that you can have underperforming board members. And I think in terms of how to deal with that and address it, the use of a method of evaluating the board's performance using objective means and either internal or external methodology and maybe organizations to come and do it, having that, as I mentioned, the 360 degree is an element of that, but if the results of that evaluation clearly indicate that an individual board director, because it should be specific to not just the board's performance as an entirety, as a unit, but also the individual performance. And just as you would evaluate a member of staff and say, yes, you did well this year or you did badly this year, it should be clear, and the chair should take this position of sitting down with the individual board members and discussing their individual performance as perceived by others, as assessed by the methods used, and where that person is underperforming, then the chair should take action. Now, if the chair is not prepared to do that, but other board members around the table feel that there is a real issue here and that that's not being dealt with properly, then I would encourage those 2 or 3 or however many like-minded board members to sit down with the chair and say, look, we are concerned about this individual member's performance for these reasons, and have an open and frank discussion with them, and try and persuade the chair to take the action that's required. In some cases, the problem is with the chair not being willing to take that action. If that's the case, and the board members feel particularly unhappy about the organisation and the way this is going, they have a choice. They can either say, well, we just have to live with this and put up with it, and when it comes to the next vote of reappointment, persuade the shareholders to not reappoint that individual member, or if they feel very strongly about something, they potentially all resign, and at that point the chair may decide, actually, I will take action because I don't want to lose half my board. So I do think there are ways of addressing it, and that's where I do think having an evaluation methodology which happens regularly and it is acted upon and is supported by the shareholders is probably the most elegant way of dealing with this, because it brings a certain level of objectivity to the process and almost gives permission for changes to be made, because this is a business decision to actually assess the performance of the board objectively and try and improve it. It doesn't, and in some instances you may have an underperforming board member who may be unaware of their underperformance, and what may be needed is not just removal but actually training. And it may be that that individual needs to be trained and mentored and coached to help them improve their contribution. So where you do have that situation of a non-performing board member, then there may be constructive measures that can be taken to address the situation. It may not just be a question of removal. It may be that they need some training, and that's where sometimes boards go away for 1 or 2 days to look at strategy, to look at and you actually have team building exercises for boards themselves. And sometimes those team exercises, which are done professionally and properly, can actually help the board become more effective and higher performing, but they may also reveal to an individual that they don't really fit in that board because the chemistry is not right, and that may provide an option for a conversation to say, really, I think it's time for you to retire or resign from this board. It's not easy by any means, but I do think the organization will suffer if it's carrying a passenger and not having a player playing what is essentially a very important role as a non-executive director, board member. You know, it's very important if you want to be a good performing board, that each individual member of that board is performing to their full potential and making the biggest contribution they can to the board. And everybody should be honest with each other and say, if I've fulfilled my role and given as much as I can to this board and served so much time, I will now, going back to the relay analogy and the race, I'll pass on the baton to another person that can pick that up and keep up the progress. Jessica.
Great. We're just going to take one more question, a very quick one that is in conjunction with this. Peter, who would you recommend should be part of the committee to evaluate the board performance? So you've talked about some different circumstances, internal, external, and maybe you could just speak a little bit about best practices and who should be involved.
In terms of, well, ironically, the people to look at that board performance, well, I suppose the question I have to clarify is it saying, do you actually create a separate committee to do that board performance? If you use an external party to facilitate that, then the whole board will be involved in that assessment. So I don't really see it as a subcommittee doing the assessment. It's the board actually doing the assessment. The board is involved in that whole process, and ideally you use I think initially certainly an external organization to work with the board to do the evaluation, and therefore the feedback of that evaluation, once it's analyzed, is fed back to the board. So it's done as a group exercise where the board provides information, other people are involved in 360 degrees and so forth, but then in terms of the results, that's fed back. The mirror is held up to the board in terms of, okay, this is how we as a board have been evaluated. So if you're using an external body to do that, then that's an easier question to answer, because that external body is facilitating the holding up of the mirror to the board. If you do it internally and say, okay, who should be the kind of the task force to drive this through, then I would say it should definitely be the chair. It should definitely be the CEO. I do think it should be the head of HR. And I would have thought you may also want somebody like the internal auditor on that as well. So I think you want to keep it quite small, but I would say those 4 individuals would be an effective work group to drive it if you're doing it internally.
Great.
Jessica.
Well, thank you so much, Peter. We appreciate it, and we're looking forward to your follow-up session in October. And we've had quite a few questions come in, and so we'll share those with Peter, and we'll answer some of those on our LinkedIn page and some of those in the upcoming governance webinars as well. So thank you again to Peter, and thank you to all of our participants as well. Thank you so much, everyone.
Bye. Bye-bye, everybody.